Application of the new revenue standard was a live webinar that was originally produced on Thursday, June 15th, 2017. The presenters for this presentation were Janice Snyder and Dan Sturm, both with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events.
Thank you, Tyler. Thanks everyone for joining us this afternoon. My name is Janice Snyder. I'm a partner here at McConley and Asbury. I lead our audit segment, and I spend most of my time serving the firm's healthcare entities, not-for-profit entities, and food manufacturers. So I greatly enjoy working within those industries, and I look forward to talking to you about them today.
Thanks, Janice. And I'm Dan Sturm. I'm a partner, and I also primarily work in the audit segment. The industries I specialize in are construction and employee benefit plans.
Thanks, Dan. Here we have our objectives for the day. So, as you know, we're talking about revenue recognition and the new standard associated with that. So, we want to help you understand the key points and terminology in the new standard. We'll give you a few definitions. We're going to revisit the 5 steps of the new revenue standard. So, hopefully for most of you, that is revisiting. It's been out for quite a while. So, we're going to touch on that in case you aren't familiar. And then we're going to update on the AICPA industry task forces. We're going to focus on 3 of them in particular. And then we're going to go through some practical examples related to these specific industries, one for construction, manufacturing, nonprofits, and healthcare. So hopefully the practical examples, you'll have a lot of questions for us. We have some different scenarios and different little tweaks on those. So we hope you'll find that interesting and that there's something here for everyone. I would like to note that this webinar really does focus on we work with a lot of private companies. Certainly the concepts apply to public companies as well, but we're certainly coming at it from that perspective, particularly when you notice the effective dates on the next slide.
Yeah, and I think it's important to note, too, that this is a 50-minute presentation, so we're going to go through a lot of information over the next 50 minutes. Quite honestly, there's several topics that we have that could probably be day-long presentations in and of themselves. So we want to give you some highlights, want to give you some things to think about, especially as it relates to your industry, and maybe give you some questions to ask us either during the presentation or as a follow-up, or if anything else, just give you some ideas on how you move forward with the new standard.
Yeah, I certainly know for construction and healthcare in particular, this could be a whole day seminar, if not beyond that.
Very easily.
So go ahead, we have our first polling question. We'd like you all to take a few minutes to answer this question so we can understand where you're coming from. So have you started to evaluate the new revenue standard and the direct impact on your business and or your financial statements?
Yeah, and I'll be really curious to see the results here and kind of where I would expect them to fall out.
Yeah, I think companies are all at different places in this process, and if you talk to a public company, particularly I talked to a public manufacturer just last week, and they're pretty far along in the process, so it was great to get their point of view that a lot of the end result of revenue recognition is very, very similar and looks a lot like it does under the old standard. However, how they get there is very different. So we do see in our polling results here that a lot of you are using 2017 to determine the impact on your business. So hopefully some of our examples today will help you as you're working through that process. And there is 11% of you, so great job, that say you're all ready to go. So please, if you want to submit any of your thoughts and insights through the question function, please do so. We'd love to hear from you.
Yeah, and it's interesting. I think this is where I would have expected things to fall out in our poll. Quite honestly, a lot of the recommendations we're giving to our clients now are pretty much used to having 2017 to get this process started and really dig in. And hopefully by the end of the year, you have a much better understanding of where your company is going to end up. With that, I'm going to jump right into it. These first couple slides, they're included in here, but I don't want to spend a lot of time on them because I know the revenue standard's been out for a while now, and I'm sure if you've attended any other presentations, you've probably seen some of these. But we do think it's still important to go through. The first bullet point here is the most important to note. This standard came out in May of 2014. I remember when it came out, you feel like you have all this time and several years ahead of you to get ready. Well, now the time is here. And so while 2019 seems like it could still be far away, it's really not when you look at the complexity of the standard. So 2017, really, if you don't have a decent understanding of where the standard is going to affect your business by the end of this year, you'll probably start getting to the point where you're a little behind. So really take 2017, as we just talked about, to make sure you get at least your understanding and a timeline mapped out. And we'll go through some more of that later in the presentation. Next, this affects all entities. I mean, so there's not any one entity or type of industry that this leaves out. In some way, shape, or form, it probably will affect your financial statements, if not your business as well. So everyone should be listening. While you may not think it impacts your industry significantly, there are some things that you really need to think about with the standard beyond just the financial statements. It is effective for annual reporting periods after December 15th, 2018. That's where we get the 2019 date that we just talked about. So that's basically after 12/31/18. That year starting for 1/1/19, this would be effective. There's actually a couple different approaches you can take under the new standard, and you can take the full retrospective approach, and basically under that approach you're going to restate all prior periods. So you're going to have comparative statements, and both years are going to be under the new standard. That means you're going to go back and potentially redo contracts and redo your accounting for contracts that you already reported on, but that's the first option. The next option, which I think we probably anticipate most of our clients to take, is the simplified approach, and that's where you adopt a standard. You have that full first year under the new standard, but then you actually can use retained earnings and your equity balances to fix the prior year. So you're not necessarily putting comparative statements next to one another, but you will disclose a lot of information related to the impact in the current year.
Yeah, the disclosures are really a difficult piece of this standard. So manufacturers, you'll see, we'll go through some examples, but a lot of organizations are saying it's not going to impact us greatly, so not as much of an effort certainly as construction companies or healthcare entities. But the disclosures may be tricky, and that may be information you don't have. So certainly when you're thinking about how you're going to adopt, gathering the information to disclose each line item of the financial statements as if presented under the prior accounting can be very time consuming to make sure you're getting that conversion correct and be able to properly present this.
No, absolutely. That's a good point, Janice. And just to point out, there's a few out-of-scope items that the FASB has been clear on: leases, insurance contracts, financial instruments, non-monetary exchanges, and certain guarantees. They do not fall under this guidance, and we will not be covering any of those in this presentation. With that, and again, this 5-step process should not be anything new if you've attended any of the other revenue presentations that we've done or anywhere else. But there are 5 steps to the model. So I'll go through those pretty quickly because you will hear about those throughout the presentation. First one, identify the contract. Next, you want to identify performance obligations within the contract. And I'll get into a little bit more detail in a couple slides from now on what a performance obligation is, as well as a contract. Next, you determine the transaction price. Step number 4, you're going to allocate the transaction price to the performance obligations. That's why it's so important to understand what a performance obligation is. Last, you're going to recognize your revenue once you satisfy either one performance obligation in a contract or multiple. With that being said, I did put the definition, or we did put the definition of a contract in these slides, and really it was for no other purpose but to highlight the fact that when you hear contract and you hear FASB, you're like, okay, if I don't have a written contract, then this really doesn't apply. Well, FASB went ahead and defined what a contract is under this standard, and it can be written, it can be oral, and it can be implied. So it doesn't necessarily represent you need a piece of paper signed by both parties for a sale. They've specified that you could have a contract, and it could fit under any one of these scenarios. It could be just generated based on your customary business practices. So depending on how you run your business, what kind of industry you're in, you could very well have a contract that definitely meets this standard.
I think it's important when you look at this to remember the beginning of that definition. It's an agreement. So I think of the healthcare side, have you reached an agreement? There's patient intake forms. There's other things that a patient may fill out. But in some cases, actually just scheduling an appointment could be considered an agreement that would qualify as a contract. So that would be more of an implied one because the individual took the initiative and scheduled that appointment. So I think there's a lot of ways to look at that, but think of this, we always say contract, but think of it as an agreement.
Absolutely. Yeah, so whenever you hear contract throughout this presentation and the guidance, refer back to this slide because it can mean several different things. Next, performance obligation. Again, we didn't go through and define everything. It was just a couple key terms we thought were very relevant to this presentation. And performance obligation is kind of a new term as it relates to recognizing revenue. And quite honestly, I think this is probably the area within the standard and within the 5-step process that I think there's the most judgment. You can have any number of transactions that, hey, I think that's a separate performance obligation, or no, I think our contract is all one performance obligation. So I think it's just important. There still will be judgment, but I wanted to make sure we clarify what the FASB defines as a performance obligation. And part of that, it's a good or service that's distinct. So basically, in simple terms, that's what it is. It's a distinct good or service. You can also have a series of distinct goods or services that are substantially the same, and so basically that is one performance obligation. So as we go through our examples later in the presentation, just keep those definitions in mind. Another term that I don't think is necessarily new, but I think is worth pointing out, just because it's a big part of the standard, is the contract costs. And it basically, in the standard, it defines if you have any contract cost or incremental cost of obtaining a contract, you amortize those over the life of the contract. And the most consistent example I keep hearing is a salesperson makes a sale. They sell some product, they sell some service, and they receive a commission based on that product. That's the most consistent example that I've seen in all the guidance that I've read, because that commission relates directly to that contract or that sale that just occurred.
So we did have a question come in, Dan, I think before we move on to, of the 5-step process, what has been the biggest challenge for your clients to adhere while looking at their business's impact for this standard?
I think it goes back probably to the performance allocation, or not the performance allocation, the performance obligation. I'm sorry. It's probably the biggest step. It's causing, I'm seeing the most questions. I'm seeing a lot of guidance out there on that. And again, it's the most subjective, because you can have what you think is one contract, and ultimately, by the time you evaluate that contract for your business and how you do things, you could end up with 5 performance obligations, yet you only have one price in your contract. So now you need to get to the point of, okay, I've determined I have 5 obligations. I have one price. Now I need to allocate that one price to 5 performance obligations. To me, it's probably step 2. Janice, I don't know if you have any thoughts on that, but to me, it's probably step 2.
I think step 2 is a big piece of that, but if we look to nonprofits as well as healthcare, step 1, identifying the contract. And as we go through some of our examples, you'll see that, but what is entailed in the contract, and how does that affect whether or not or when you recognize the revenue? So I think our examples will help clarify some of that as well.
Yeah, and I think as you'll see through our presentation, and as we present more presentations in the future on revenue, as more guidance comes out, it's constantly evolving. So a lot of the public companies are going through this now, or maybe just finished their first phase. So you're going to start seeing more questions, more things go back to the AICPA, to the FASB. So it will evolve. So we'll get some more clarifications on where the complexities truly lie once these things are actually applied and not just talked about. With that being said, one of the objectives of this course, the AICPA does have industry task forces. There are 16 task forces, and focused on the industries that I think, in my opinion, would be affected the most. We are not covering all the industries in this presentation by any stretch, but on this slide you'll see all the industries that have task forces and that will have separate guidance from the AICPA. The 3 task forces that we'll focus on in this presentation are construction, healthcare, and not-for-profits. But again, just be aware that if you're in an industry that's listed on this slide, there's a separate task force, and what that means is there's more guidance out there for you. And if it's not ready yet, we hope within the next few months that we'll have a little bit more clarity, and they're going to provide examples and just a little bit more information to make getting your financial statements together a little bit easier.
Yeah. And a lot of the individuals that are with us this afternoon do come from construction and healthcare, and I don't think we have any nonprofits unless they're a healthcare nonprofit with us today, but we also have a fair amount of manufacturers, so we are going to go through a manufacturing example as well. Even though there's not a task force for that, you don't want to dismiss this standard and think you won't be affected. You won't be affected, I think, as significantly as some of these other industries, but you still will be affected in your revenue recognition.
No, absolutely. And with that, the first task force that we're going to focus on is construction. And I'm not going to go through every one of these in detail, but I'd like the group, especially those on the call that are in the construction business, to understand what the FASB or the AICPA is actually working through and some of the things that they're going to put in the guide. I will first start with the guide is not complete for construction. It is not out there for our reference yet. I'm really hoping within the next couple months that's out there, because as we have these conversations with our clients and prospective clients, it would be very helpful to have all this information in this revenue guide to point to examples directly from the AICPA that have been well vetted and that are consistent with what the guidance is intended to do. The first issue under construction is identifying the unit of contract. So you'll see over in the status column we have some that are final, some that are submitted. This is actually final. So once the construction guide, revenue guide comes out, this item will be in there. So the revenue guides are out there. So as these items are finished, they're added to the guide and updated. So what they're doing is they're taking questions that have come in throughout the industry. Certain industry groups maybe need some more clarity within the standard as it relates to their industry. So they're trying to take these issues and make sure they're addressed in the revenue guide. And as I look through these lists for all the industries we'll talk about, these are definitely things and questions we'll have, and so it'd be helpful to be able to use that guide to point to that to make sure we're getting it right. So the first one, as I just mentioned, is identifying the unit of account. Number two, I think, is a big one, variable consideration and estimation method. And so that's final, so I think we have a lot of guidance on that, but again, it's construction, so we do have a lot of variable consideration. We have award payments, we have claims, we have change orders. So any of that could be variable, so that's where probably a lot of the guidance is going to need to come from. So I'm hopeful once the guide comes out and all that language is in there, it's very helpful, especially for private companies, to help guide them and give them a lot more information. Number three, acceptable measures of progress. Again, that one is final, but that is, how do you determine when performance obligations are satisfied over time, cost to cost, labor hours, things like that. So there should be a lot more clarity with that once the guide's out. Next one, again, construction. So we have uninstalled materials. You may have materials stockpiled to start a job, you haven't used them. So this information is not final, but it's been submitted. So I would expect in the next couple months we're going to have more information on uninstalled materials, how to account for that, does it sit in inventory, things like that. So there should be more clarity with that. Issue number 5, impact of termination for convenience on contract duration. And this is basically customers have termination rights in certain contracts. And so this is out for exposure at this point. Just understand, when you have that language in a contract, how does that affect us recognizing revenue if 3 months from now a customer can terminate the contract and revenue you recognize and things like that. Next, contract costs. Again, getting into things that are subjective with pre-contract costs or costs that qualify for capitalization. How are all those handled as part of the contract? Again, there's a lot of guidance out there. There's a lot of interpretations on what's already in the standard. There's just more information that I think would be helpful to make it more user-friendly and easier for those in the industry to understand, and hopefully this covers that once it's finished. Lastly, as Janice already pointed out, disclosures are big. So if you have no other changes in your industry, and construction specifically, if you have no other changes and it doesn't affect your net income whatsoever, you are going to see big changes in disclosure. So we're going to need a lot of clarity on that, on what's required, to what extent, how many pages of disclosures are we actually going to have to put in our financial statements, and what do they need to include. And again, that one is not final. It's been submitted. Hoping within the next couple months, most of these, if not all, are final, and we have good guidance from the AICPA to work through.
Thanks, Dan. So as I said, we're focusing first on 2 of the industries most significantly affected, and right up there with construction is healthcare. And the healthcare task force has been very busy as they're addressing 10 different issues. I'll walk through a couple of them that have been finalized at this point, and my example in particular goes to issue number 1, application of step 1 for healthcare. So this addresses a lot of self-pay patients, including uninsured patients, amounts where you're getting co-pays from individuals, and a lot of the high deductible plans that are out there. So what is your likelihood of collecting that? So it really looks at, does an enforcement enforceable contract exist. So you have to think of what has the patient agreed to, have they signed certain forms. Some organizations go through a process of income verification and other things like that as they're required to. Did the individual schedule an appointment, like I mentioned earlier? So they're all things that could indicate that a contract exists. The second step in this one that they talked about of, is it probable that the entity will collect substantially all consideration? So, and this is all consideration that they would expect to be paid. So those of you in healthcare know you have gross rates, and then a lot of times you write them down through a contractual allowance. So what is the amount that you would expect to be paid for that service? And then are there implicit price considerations? So this is a big one that they actually turned into a separate project, Project 1A, to look at this in a little more detail of, do you know when you are seeing that patient that even though it may be $500 for that service, you're willing to accept $200 because that's what other commercial insurers would pay you. So how do you account for that, and how does that affect your revenue recognition? So the implicit price concessions, that has been submitted to the FASB's technical resource group to continue to work on that aspect of it. The second one is application of the portfolio approach to contracts with patients. So this one is final as well, and I'm spending a little more time on the two that are final. So this allows you to take, instead of, the standard is very clear that it is to be applied on a contract by contract basis, but this allows you to take a portfolio approach to your contracts. So you can group things by either the type of service you are providing, by potentially the type of payer. So is it a commercial payer? Is it a government payer? Is it self-pay? Patient responsibility can drill down on that. Is the copay portion a separate piece of that, or a separate bucket? Is the high deductible a separate portfolio? And the other one is the timing of when you could receive that revenue. Is it someone comes in and has a visit for 30 minutes and everything happens within that time frame, or is it an inpatient visit that's over a period of time? So you could group different things based upon the timing. And this does require you to consider all information available to you, and the standard specifically says historical, current, and forecasted. So if you know you have rate changes coming in the future or something you need to take into account, you'll have to look at that as you look at your portfolio. Issue number 3 deals with continuing care retirement communities. I didn't think we had any of those on this webinar today, so I'm going to kind of skip over them. These can get very complicated, so I'm going to move on, because issue number 4 and 5 are also specific to continuing care retirement communities, and these have been submitted and exposed and had to be resubmitted as they're still continuing to work through some of the really complex elements there. So going to number 6, this one is out for exposure right now, and this is open for comment through August 1st, 2017. So this is really, what are the disclosure requirements to break down your revenue by nature, amount, timing, and uncertainty of the revenue and cash flows. So you can think of it, again, by revenue by type of payer, government, commercial, by region, if you operate in different regions, different states, by type of customer, are they inpatient, are they outpatient, those sorts of things. And then 7, 8, 9, and 10, they're all still working on all those, but certainly step 2 is determining your performance obligations, so there's a whole project on that in number 10. And I probably shouldn't have skipped over number 9, bundled payments, for those of you who get paid with CMS funds, so Medicare and Medicaid, and you get bundled payments. How are you supposed to recognize revenue for those? So certainly a lot of issues that are still being worked on by the Healthcare Task Force, and there's a lot to come in this area.
It's a long list, and I don't think I realized the impact on healthcare until I sat down with Janice for this presentation. But construction always came to mind for me as a huge impact. But then as we sat down, healthcare is maybe even more significant.
I mean, there are a tremendous number of examples, but you even think of like an elective surgery, like a hernia operation or something like that, Dan. You have the pre-op visit, you have pre-op lab work, you have the surgery itself, then you have follow-up visits, and a lot of times you're getting paid one price for all of those. And so when do you recognize each piece of revenue, and what are the performance obligations, and how would you break that down? So, and that's just one example.
Absolutely.
And you layer in the complexities of healthcare and self-pay versus commercial and government payers, and there are thousands of possible scenarios.
Nope, I can see that.
So the not-for-profit task force, there are still implications here. They're not quite as lengthy as construction and healthcare, as we just said. This guide is also not complete, but two of these issues are final. So the first one is tuition and housing revenue. So there's considerations here that they address to determine the transaction price and also when to recognize tuition revenue and housing revenue. This was really focused on higher education institutions. When you look at contributions, this one is final, and they have concluded that contributions are not within the scope of this new revenue standard. So you get to stay with the guidance you were following in ASC 958. So they have clarified that because there was a little uncertainty on how this could impact contributions for nonprofits. And the good news is it does not. They're still working on grants, some subscriptions and membership dues. If anyone has those, this is really focused on lifetime dues and lifetime subscriptions. So when you get a lifetime benefit, when do you get to recognize that revenue? And the last one is bifurcation of transactions between contributions and exchange components. And our example touches on this a little bit, where you can have part contribution, part exchange, where you're getting something in return for that. And it really focused on that. So with that, we have our next polling question. Do you think the new revenue standard will have a more significant impact on your business processes or financial statements?
It'd be interesting to see this question before the presentation than after.
I just think gathering the information will be significant, even if the only thing that impacts you after you've gone through your assessment is disclosures.
Yes.
Gathering all the information for those disclosures, you just may not have those processes in place.
Yeah, no, so I think, not that there was a right or wrong answer, but I think that's the good answer, that people are seeing that, because as I've talked to my clients, this is not just going to affect accounting. Like, it's not just the accounting team that has to deal with this. This is top to bottom, could potentially, depending on what type of industry you're in, could affect a lot of processes within your organizations. So, no, I'm glad to see that people are seeing that.
I'd be interested to know the industries that say they do not anticipate significant changes. Yeah. I know I've talked to some manufacturing clients where the changes may be minimal, but they still do have to make sure they have all the information and that they're looking at warranties, returns, things of that nature that could impact how they're recognizing revenue.
No, and it's a great point, because the net amount at the end of the day may result and may be exactly the same. So there may be no changes in the dollar, but you may look, if you've never looked at the disclosure because you think it's not going to apply to your industry, you absolutely should, because there could be information in that disclosure that you just don't have at your fingertips at this point. So I think in some way, shape, or form, this will impact almost every type of business that we work with, whether it's a change in a disclosure that all of a sudden requires all this new information we don't have, or an overhaul of the accounting, like we were talking about with construction and healthcare. Mm-hmm. And with that, we get to our first example. We're going to start with construction. And again, there's so many different scenarios that could occur with construction. So what we tried to do here with this example is to do something basic enough for this presentation, but also to give a couple of scenarios that you may see and to bring in some of the new terminology. So again, it's been pointed out to me by someone else that looked at this example, a $90 million bridge being completed in this kind of time period. Probably not realistic, but that's not probably the point of the example. So I just want to walk through this. But yeah, basically there's a contract that has been signed on June 1st, 2017. It's a fixed fee design build contract for a bridge, and the price was $90 million, and it's to be completed by December 15th, 2018. There's also within the contract a $10 million incentive/award for completion prior to November 15th, 2018. The contractor, it's not the first time they built the bridge. It's a long history of similar projects, and based on previous experience and all the other bridges they've built, it's probable, 95% probable, that they will complete the bridge prior to November 15th, and that's a key date because of the incentive above. So another fact in this situation, after they started the project and on January 1st, unpriced, and the key there is unpriced, change orders are entered into for changes to the project. And another point, management has a history with this job owner, whether it be a state, it's most likely a state Department of Transportation, so they've built bridges for that state before, they've worked with the same people before, so they have that experience, and while the change order is unpriced, they consider it probable that they will agree and be paid $5 million for that change order. Management at 1/31/2018 estimates that the contract is 25% complete. And to go just the bullet point ahead about the unpriced change orders, I don't typically see a lot of unpriced change orders. Most of the change orders, especially of this size and scope, are usually agreed to with a dollar amount before the work started, and I agree that's a best practice. However, throughout the guidance and even in the literature from FASB, there's constant reference to unpriced, so I wanted to make sure that we address that in this example. So again, back to the 5 steps. We identify the contract. I think with construction this is fairly straightforward, especially for the base contract and a contract of that size and scope. We have something written, signed, we can identify the $90 million. Pretty straightforward. Step 2, this is where you start getting into the complexities and the judgment. And so you'll see I highlighted a couple things in this example. Step 2, identify the performance obligations. And the point I want to bring out is, are the design of the bridge and the build of the bridge separate obligations? Now we have one price, $90 million. It's to design it and build it and get it finished. Step 3.
Dan, on step 2, when would you typically see 2 or more performance obligations? Because I could easily see how this could be.
No, absolutely. I think for this example, we're going to consider this to be one obligation, and we're considering that one obligation because the design and build are so interrelated. So basically, from start to finish, the whole objective is to build a bridge, and the design and build. While you could make the argument they could be 2 separate performance obligations. The guidance and the examples and what we're seeing at this point, they're so interrelated in this example that it's one performance obligation. To Janice's question, if you build a bridge and it's maybe going into like a more touristy area, like a beach or something like that, the bridge might have like a visitor center. So they complete the bridge and part of the contract says, okay, you have to build a visitor center. That's an example where I could say, okay, that is completely separate. And while you have one price, that visitor center is now a separate obligation. So in that case, you would take that $90 million, and knowing this contractor has experience with these types of projects in the past, they can definitely allocate what the bridge is going to cost versus the visitor center. So it's easy to allocate. I wouldn't say easy, but they can allocate that price to those separate obligations, even with only one price. So that goes to step 3, determine the transaction price. And the question I came up with here for this example, how do we account for the unpriced change orders and incentive payment? And the point from the previous slide is in both examples, both the $10 million incentive payment, again, contractor has a lot of experience building bridges. They don't expect any weather conditions to get something done by November 15th. So they feel everything's within their control. And so they absolutely have no reason at this point in time, as of January 31st, that they will not receive that award. So it's 95% probable in their opinion. So if that is the case and they determine that amount is probable, that's actually included in the transaction price as well. And then the unpriced change order, same situation. They have experience with this customer. They have experience with this type of work. They know what it's going to be priced at. They fully expect and consider it probable that they're going to receive $5 million for that unpriced change order for that change to the job. So that's another amount that would be included in the price. Step 4, allocate the transaction price. As we determined in step 2, there is only one performance obligation in this contract, and that's design and build is all one obligation. So one price, it's allocated, so we don't have that complexity of allocating it to different performance obligations. Lastly, you're going to recognize revenue. And how should it be recognized over time? As we talked about, most of what I expect to see and have seen in the past is cost to cost. So at the end of the day, I don't expect a lot of changes in your bottom line revenue that are recognized through this contract compared to how you used to recognize it. So again, just to go through some of the numbers we just talked about. We took the base contract, we added the incentives and price changes, got to a contract of $105 million. We have our costs. We have our costs incurred through 1/31/18, and we have our percent complete. So again, I don't expect a lot of bottom line differences in this specific situation. Not saying it couldn't happen, but based on this breakout and how we're allocating things and only coming up with one performance obligation, I expect a lot of consistencies to how you've done things in the past. with a similar type of contract. So again, very basic example, still judgment involved. Every contract may be different, unless all your contracts are worded the same and you're doing the same type of thing over and over again. But you're going to, especially in the earlier years of adopting this standard, need to understand these terms. Your teams, especially if you have a sales force that's selling projects, they're going to need to understand at what point we may have separate performance obligations, how that affects revenue. You could potentially have a timing difference. Cash is cash, so you have $105 million. At some point in time, you're going to collect all that cash, hopefully. Where things could change is you could have timing differences under the new standard. So with that, I'm going to kick it over to Janice.
Yay, we get to move on to a healthcare example. So certainly saw a lot of complexities and judgments that can come into the construction example. You're going to see similar things in healthcare. So this is a very simple example, but I'm going to give you two scenarios on how you could end up with different amounts of revenue being recognized on that. So the background is it's an urgent care clinic that treats an uninsured self-pay patient. The standard charges for the services provided to the patient are $1,000, and a bill is sent to the patient for this amount. The clinic, based upon history, believes it is not probable it will collect substantially all of the billed amount. So that's just a little background. Maybe someone just walks into your clinic, and I think I go to urgent care clinics all the time, so this definitely could happen. So let's go on and take a look at this in the context of the revenue recognition model. So I've highlighted here step 1 and step 3. So step 1 is to identify the contract, and is there an actual contract? So you have to look at, did the patient fill out forms when they came in, a patient responsibility form, anything regarding payment. In this case, it could have been scheduled in advance or they could have just walked in. But is there anything that indicates we actually have a contract? The second thing is it probable that the entity will collect the consideration to which it is entitled? And in healthcare, that's a lot of judgment in that. You may be entitled to $1,000, but a typical commercial insurer would only pay you $400 for those services. So you have to think about what you believe you would actually be entitled to. In this case, they are uninsured and a self-pay patient, so you have to think, will you or won't you collect that? So, and then on step 3, what is the amount of consideration the entity expects to receive? So once you've identified you have a contract that you may collect, because step 1 looks at intent and ability to pay. In step 3, you kind of revisit that. So what is the amount of consideration the entity truly expects to receive? 1 is, do you think you'll collect what you're entitled to? Step 3 is, what does the entity expect to receive? So, and you can see in step 4 there, the allocation objective. So allocate the price on the relative standalone selling price. So did you have labs, cultures, physician exam, those sorts of things that are all kind of bundled up in that $1,000. And then step 5 is it must be probable that a significant reversal of the revenue will not occur in order for you to recognize it. So if you move on, Scenario 1 in this example, the entity does not assess the intent and ability to pay at the time of service. So I know like federally qualified health centers have to do income verifications and go through a certain process before they see a patient. Most organizations do not, but I know my urgent care clinic, they take my credit card. So it depends on what you do at that point of intake. But in this case, the entity did not assess that, did not get a credit card, did not look for anything, and sufficient historical data does not exist to determine the likely amount to be paid. So you're going to bill $1,000, but you really don't know, based on this type of uninsured patient, how much you historically collect on this type of payer. So under step 1, it is not probable the entity will collect substantially all of the consideration it would be entitled to. And under step 3, the entity does not expect to receive the consideration. So in this scenario, no revenue would be recognized at the time of that service. So previously, you would recognize revenue and then maybe have an allowance for doubtful accounts. In this case, you wouldn't even record the revenue. But then what happens later when you actually receive cash, if you do, in the unlikely event, then you would recognize the revenue at the time you receive that cash because of the facts and circumstances here. So certainly there's a lot of nuances at play, but let's look at scenario 2 on how this could be a little different. So the entity does, the organization, when they walk in, the clinic does assess the intent and ability to pay, either through income verifications. You could take a credit card, you could do a credit check on that. And then your historical data would indicate that 25% of self-pay patient revenue when you do income verification is collected. So under step 1, it now becomes probable that the entity will collect the consideration. And then under step 3, how much do you expect to collect? You have to have the history to prove you're going to collect 25% of those gross charges. So in this scenario, you would recognize revenue of $250 at the time of the transaction, and then the revenue would then further have to be allocated to each performance obligation. So I did not get into that piece in this example, but certainly there could be a lot of things to think about. And even slight changes in these scenarios can change the timing of when you recognize revenue or if you even recognize any revenue at all. So self-pay patients and self-pay portions of payments was a really big focus on the healthcare side and one they tackled first.
Yeah, and I mean, I'm looking at this, and again, I don't do a lot in healthcare, but I can see a huge shift in what revenue looks like from one period to another. And then I think about all the, whether it be a pharmaceutical company, all the people that are in sales that may be receiving bonuses and commissions off a gross revenue number. This could really make big changes in their industry and even just how they're paid and things like that.
Mm-hmm. All right, let's move on to a not-for-profit example. So a statewide association charges $4,800 to its members for annual dues. Association members receive, in exchange for their $4,800 fee, access to educational events, conferences, industry data, and advocacy efforts as part of their membership. They also get a subscription to a publication that's published 6 times a year. And that publication is typically sold to other organizations who are not members at an annual price of $600. So this focuses on one of the issues that the nonprofit task force has worked on and concluded on as well. So let's take a look. So we have to look, is there an actual contract? So we do have a contract when you're paying those membership dues. What services were performed as part of the membership and how many services? What is the bundled price here? So we know we have the $4,800, but how do we allocate the transaction price to the performance obligations? And when do we recognize revenue? Is it a point in time versus over a period of time? So I don't think we have any nonprofits on here, so I'm going really quickly on this one. If you can go to the next slide. Yes, there is a contract between the member and the association for performance services. We have 2 performance obligations. One is the access you have to the conferences and events and data, and the second is the subscription to the journal. So in this case, we've made it pretty simple that $600 would be allocated to the subscription and $4,200 allocated to membership services, and you would recognize that subscription at $350 a month over the 12-month for the membership services, and you would recognize the membership services, and then you would recognize the subscription separately at each time when you send that publication, so $100 each time you send it. So that could certainly change how some organizations are recognizing revenue for these. So let's look at it a little bit differently. What if the only benefit was the bi-monthly newsletter, but you're still paying the $4,800? So we have a standalone selling price for the subscription and for the newsletter that comes out every 2 months. So you recognize that at your $100 every time you mail that for the 6 times. And then the $4,200 would be considered a contribution, and you would be back over into the ASC 958, the not-for-profit guidance for contributions, and you would follow that guidance. So depending on the circumstances, in a lot of cases, the $4,200 will be recognized as revenue right away. So that concludes nonprofits. As I said, that was quick. So now we're going to move on to a manufacturing example, and I know we have quite a few manufacturers on this webinar. So
no, absolutely. When I first saw the standard, my initial thought was manufacturing wouldn't be that impacted, and I still kind of feel that way. But the industry is not untouched from this standard, especially when you talk. Janice already pointed a couple things, including warranties, and that's what this example highlights. Just a warranty may create a separate performance obligation. So that's one item that I want to highlight, if anything, in this example, just to get people thinking beyond disclosures that you could have more than one performance obligation in a manufacturing scenario. So in this example, we talk about a manufacturer sells a computer directly to a consumer, and it could be any product, doesn't have to be a computer. Cost $1,000. Within that $1,000, you get a 2-year warranty that it covers manufacturing defects, and also you have an extra warranty that covers customer-inflicted damages. Think of broken screen, customer drops it, they break the screen. So there's an extra warranty coverage that was basically enticed to get them to buy it. Hey, well, you dropped the computer, it's included in the price, we'll fix it or replace it. Basically what that means is, under the new standard, customer damage portion of the warranty could be considered a service type warranty. And I say could be because all this is subjective depending on the type of industry and what types of transactions and how you historically have handled these transactions. But could be considered a service type warranty, and can also, this is the big point, can also be purchased separately. So maybe that was a special at that time to buy it, but previous to that, this is a warranty that would have an extra cost associated with it, which is a big indicator you have another performance obligation. The estimated value, the service type warranty is $120. That $120 comes from, that's what it's sold for separately, and the estimated cost of manufacturing defects is $48. And that's just based on historical experience with fixing those products. Step one, identify the contract. I think we've went through that on a few examples of what a contract could be in this situation. Step two, this is what I wanted to highlight, identify the performance obligations. Should the warranty be a separate performance obligation? And the answer to that is maybe. And so basically with the obligation, the defects warranty I would not consider a separate obligation. But the service type warranty I would consider to be a separate obligation based on the scenarios that I outlined before. It could be purchased separately. It's kind of above and beyond just keeping the product in its normal condition. Second point here is, what if the entity is not able to estimate the value of that extra warranty? So we used 120. It was easily estimatable. According to the new standard, if that can't be estimated or they have no idea what that extra warranty would cost, then basically the guidance allows room for you just to say, okay, we don't have a separate obligation because we can't estimate that separate piece of the transaction price, so we go back to 1. But we're going to assume 2 in this scenario. Determine the transaction price, so that's going to be the $1,000. We're going to allocate the $120 to the service type warranty. The defects warranty, from your experience in the past, that would not change. So you're going to accrue that warranty just like you always have and recognize that expense. Step 4, allocate the transaction price to performance obligations. We just went through that. So we took the $1,000 and allocated that to the 2 performance obligations based on the prices we talked about. And then we're going to recognize revenue. And if you can flip to the next slide. Just went through the first couple bullets, the purchase price and the $120. So the $880 from the computer, we will recognize as soon as basically the control transfers to the customer, basically the customer receipt of the computer. Why it's important with the 120 and recognizing that as a separate performance obligation, that's going to be recognized over the service warranty period. So if you hadn't done it before, you would have recognized $1,000 up front. Now you're recognizing $880 and then recognizing $120 over a 24-month period. Now multiply that by 100,000 units if you're a big enough company. That number and that timing difference starts to add up really quickly. And as I just pointed out, the defects warranty, record that just like it always has been.
I think as I look at this, Dan, for some organizations, they may have already been doing something similar to this. And as that one manufacturer said to me, the end result doesn't look any different. It's just how we get there and the process we have to go through, contract by contract basis or a portfolio approach to bundle certain contracts and make sure revenue recognition would be similar and follow that process. You may end up at the same place you were before, but you may not. And I think going through some examples and kind of proving that to yourself and to the organization, if you think nothing's changed, take a handful of contracts and kind of prove that nothing has changed in what you are doing so you can make sure you're following the new standard.
And back to the disclosures we keep talking about. Read through that disclosure and make sure that even if the dollar amount hasn't changed, make sure you can at least track the information you need to disclose.
Great. Before we move on to next steps, we did have a question come in, which I think would be for me. It's for a healthcare entity. If revenue is based on estimated amount, factoring in an allowance for self-pay patients, would there be an additional adjustment necessary? So when you think of self-pay revenue, you're looking at to determine if you have a contract, whether there's intent and ability to pay. So with some organizations I've looked at, have you really determine the ability of that individual to pay. Now, have you entered into an agreement or a payment plan, or have you taken a credit card up front if it would cover the cost of those services? I sometimes think a lot of individuals have LASIK eye surgery or something like that. There's usually a payment plan in place, and even though they're self-pay, it's very likely you're going to collect a lot of that, or you believe at the time you're going to collect that. So you have established the contract. So on the assumption that you're doing a lot of the correct upfront things and factoring in an allowance, your self-pay revenue may be the same. So I don't want to be too short in that answer, but if you're doing the correct upfront work, I have a healthcare organization I work with that will do modifications to homes for disabled individuals. They go through income verifications, credit checks, they sign agreements for all the self-pay portion. So they're going through a number of steps to make sure that is a true contract and that it would be collectible at the time they enter into that contract. So at that point in time, I mean, they may be looking at bad debt down the road. However, at that point in time, they do believe that they would be paid what they expect to be paid for those services.
Good question.
We had one more question here. I think we could both. Are they still working on disclosures for all industries? Like, do we have drafts at this point, or are they finalized?
I think we know the basics of what needs to be in the disclosure. That's in the standard. I think the nuances of each industry is what's probably being worked on and what you'll see more of in these industry guides. So we know what the disclosure should be. But as most of these industry groups find out, every industry might interpret the guidance a little bit different. So as these guides come out, I think you'll just get more clarity as it relates to your specific industry. But the disclosures themselves they're out there and they've been out there.
Yeah, and we highlighted 3 of the task force. 2 of them are working on disclosure items, and neither one of them are finished at this point. Okay,
all right,
go ahead, Dan.
That gets us to next steps. I mean, so the standard's in play and you're working towards it. What should your next steps be? What should your takeaways from this presentation be? Point number 1, at least from a basics perspective, and hopefully this presentation was helpful, understand some of the changes that are coming your way compared to current GAAP as they relate to your industry and your business. So again, I don't necessarily expect anyone to read the full standard and understand it and teach it, but at least understand the basics and what it's going to start doing to your business and your financial statements. Next, develop a plan and a timeline. Figure out who within your organization should lead this, especially if you think it's going to be significant. If you're in healthcare, if you're in construction, but quite honestly, all the industries, you should identify a point person to work, whether it's internally, work with your service providers to come up with a plan and timeline. An example would be, hey, by the end of 12/31/17, I want to understand at least what type of contracts I have, how each type of those contracts is going to be impacted by this new standard, and which of my processes are going to be impacted. So you don't need to have everything resolved, but have that plan in place and a timeline on when you want everything to happen and be done.
And build cushion into that timeline, because it's probably going to take longer than you expect.
Absolutely. Next, identify resources, help train your professional staff. Again, you may have a full-on accounting team within your department that's going to be responsible when new standards come out. You can take care of this. If you don't, make sure you're working with your service providers. Make sure you're calling us. We will definitely be glad to help you work through this transition and understand the standard more specifically as it relates to your business. Last, evaluate your current contracts and compare old GAAP with the new standard. I just think this is important because, again, we have a $100 million construction contract. Assuming no change orders and any other issues aside, you're going to receive $100 million. It really gets down to timing. So I think understanding how the new standard affects the timing of your revenue, I think, is huge. And some of the projects that we're working on, we're actually working with clients now to take some of the contracts that are already done, finished, complete. Maybe it's been a 3-year contract, and we're kind of just saying, okay, under the new standard, this is how the timing would have looked. And so that gives them something to go back to their boards, to their senior leadership, and say, okay, this is what it's going to do. This is exactly how it would have affected our old contracts. So I just think it's a good practice to do that.
Yeah, touching on that current contracts, I think it's good to take a sample of those regardless whether you think this impacts your industry or not, and really just go through the exercise of walking through the steps and see if there's anything where you go, aha, I should have thought about that, because you might be surprised as you walk through the 5-step process with your contract in hand. In terms of additional considerations, I mean, you need to think about the impact on the organization. How will this affect some of could it be your debt agreements? Could it be the users of the financial statements? Will it affect your covenants, borrowing capacity? As you shift timing of revenue, that can certainly affect a lot of things, including impact on taxes. And we have down here impact on information technology. I just saw last week an hour-long presentation about companies that are only working on the IT portion of this revenue standard. Do not underestimate this, particularly organizations that are running two different revenue recognition standard systems in parallel to capture data so that they can present both information for both years so they can be comparative. And you're going to have some of that information regardless of how you adopt that standard. So don't underestimate the way you're capturing the data and how you're going to take all your contracts and evaluate the new revenue. And impact on bonuses and incentive compensation. As revenue may change, as your bottom line may change, that certainly may impact some of those agreements. And I would bet the individuals receiving them and the board or whoever is approving them would want to know as far in advance as possible to what impact this could have on those agreements. So that concludes our presentation. We did get a lot of live questions as we were going, and we have gone pretty much right up to the end here. So we have a few other questions. We'll reach out to you individually to respond to those questions. We hope you found these examples useful. We really wanted to make it practical for those of you in industry and at least give you something you can relate to, even if certainly all the industries won't affect your business, but we hope you found that helpful. And Dan and I's contact information is there on the screen, so please don't hesitate to reach out to us or to email us if you have any questions.
Yeah, and I think just before we finish up here, if there's anything specific you'd like to see maybe in a later presentation this year, it'd be very helpful in your feedback. Maybe just to say you'd like to hear a little bit more about something more than just a question. So by all means, leave that in your feedback, and we'll be glad to consider it.
Yeah. And I wish we could be here for 8 hours to go into all sorts of details and answer all the questions that you have. But hopefully this overview was helpful and the examples were helpful to each of you.
Thank you once again for joining us for this presentation produced by McConley & Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again and have a great day.